Do you want to know what's the worst tax provision that the Treasury has ever put together? I've been doing tax returns for over 10 years, and this one tax provision that's specifically applicable to expats and people investing outside the US is the worst thing you can accidentally get caught into. This one provision is the one that trips up the most of my clients and causes the most pain and anguish for both me and them. And the provision is called PFIC, the Passive Foreign Investment Company. And what it is definitionally is a PFIC is a foreign corporation where the assets of that foreign corporation, more than 50% of those assets generate passive income, or more than 75% of its income comes from passive type assets. So think interest, dividends, things like that. So that's a very technical definition, but practically there's two main areas where people accidentally fall into this. The first one, and probably the most painful one, is foreign mutual fund. If you live in the UK or any other country and you're earning income there and you want to invest there, you hire an investment manager to help you invest funds, they're generally going to invest to some extent in mutual funds. And those mutual funds are going to be local to that country, obviously. And so you're going to have foreign mutual funds, and mutual funds are usually, by definition, foreign corporations, and all they receive is passive income, and all the assets they have are passive assets. So they are, by definition, PFIC. And what's negative about this is that the PFIC, the default rule is it's taxed at your highest rate, and there's an interest charge over the holding period. So for example, if you invest in a foreign mutual fund that's a PFIC, and it gives you a dividend during the year, or you sell it, it's going to be taxed at a 37% rate. Doesn't matter how much it is. And there's going to be a bunch of tax compliance. You have to file a form 8621 on your individual tax return, which creates more fees for your tax return. So it causes a lot of complication and tax. And to make it worse, a lot of times you're investing in a foreign retirement system that maybe the IRS doesn't recognize. And so you're not being taxed in the foreign country. You're being taxed at the highest rate in the US. So there's no foreign tax credit. So it gives you kind of the worst of both worlds. So you have to be really careful with foreign mutual funds and, quite honestly, just avoid it on the front end. One thing we found is you can't necessarily just assume that a foreign mutual fund is a PFIC. A lot of tax advisors out there, as soon as they see foreign mutual fund, they just start telling you the fees for PFICs and how terrible it's going to be. In a lot of cases, it's true. But if you're liking this video, you should really check out my newsletter where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. You can't just assume that. For example, we found in Canada, and I have a colleague that's spent a lot of time looking into this, but in Canada, a foreign mutual fund may not actually be a PFIC. And that's because the fund itself may be a partnership and not a corporation. And if it's a partnership, it can't be a passive foreign investment corporation. It's a partnership. So you can't just assume that it is a PFIC. So it's good to get somebody that has familiarity with that particular country in particular, but not just automatically applying the PFIC rules, although I guess at the end of the day, it's just something you have to contend with these foreign mutual funds. The second place I see this most commonly people get trapped into it is with, say, a holding company. So for example, I had a client recently that moved to the US from China, and they were invested in a Chinese holding company that held several operating subsidiaries. But the holding company, all it had in there was he put cash into the holding company that invested in these operating companies, and the operating companies pay a dividend. So that holding company, although there's functioning operating companies underneath it, the holding company is a passive asset because the only income it generates is passive income, dividend income. There's look-through rules and things like that we can look into depending on the ownership structure. But in this case, he had a minority interest in these subsidiary operating companies, so we couldn't look through it and we couldn't apply an exception. So he was subject to the same thing, the PFIC rule, the default rule being highest tax rate and interest charge over the holding period. So there are a couple ways to make it a little less painful. So that's the default rule. There's also a mark-to-market option that you can elect into, which is a little better because you're not at the 37% rate, you're at your marginal tax rate, but you're still paying tax. You know, it's a mark-to-market system. So you're paying tax, or picking up income at least, on income you didn't actually receive in a lot of cases. The next best option is the qualified electing fund, or the QEF. And so in that case, it basically treats it kind of like a look-through. So you can elect to treat the company as a look-through through, or a QEF where you're picking up the income of the company itself. So in my example with the Chinese company, you would treat that as a QEF election, or you would make the QEF election for that company. And then as it receives dividends, you would be able to pick up those dividends as income at your regular rate. So there are ways to soften the blow, but especially on the mutual fund side, there's not a lot you can do. And the bad part is, if you do it too late, it triggers a deemed sale. So you can't have held these PFICs for years and then say, okay, I want to make this QEF election to make it not so bad. Well, you can do that going forward, but we have to make a deemed sale election today to get you into that system. So the best thing for PFICs is to never get in it in the first place. That's the best thing you can do. For example, with the Chinese company, we were able to do some structuring to make an election for the underneath subsidiary companies to flow that income up to the holding company so that it's no longer considered a PFIC. But again, timing is everything. So if you have situations where you think you may be getting into this PFIC scenario, talk to someone sooner than later so that you can get it structured correctly on the front end so you're not hit with unnecessarily high taxes. And if you're already in a PFIC scenario, talk to an advisor to see what's the easiest way to get out of it. A lot of times we have to work together with a financial advisor because unfortunately the best way to get out of a PFIC is to sell low, which is not the best financial advice. So it's finding a balance between those two. But if you have questions about PFICs, or if something in this video sounds like it may impact you, leave a question in the comments, like and subscribe to my videos. I have a lot of things out there about PFICs and how to tell if you're subject to this or what the tax rate could be. And reach out to us at McGowanTax.com, where you can schedule a call with me personally and we can look at your specific tax situation to see what works best for you. If you're enjoying this video, please take a minute to like and subscribe to our channel and leave a comment below.